Which assets should you invest in to build wealth? We will answer these questions. What investable assets are there? What returns do they generate over the long term? What are the risks associated with these investments? Among all investable assets, the common ones are housing, equity, bonds, bills, deposits, other financial assets such as corporate bonds and asset-backed securities, and other non-financial assets such as buildings, machinery, and equipment. Bills are similar to bonds, but with shorter duration. We'll lump them in with bonds in our discussion. Deposits can be similar to bills, having a fixed return, but like bills, I see deposits as a cash equivalent. Corporate bonds are like bonds, but with a credit spread associated with the corporation that issues the bond. You get higher returns with risks such as default. Asset-backed securities, commercial buildings, machinery, and equipment are difficult for most people to access and a bit non-traditional. There are other real assets and commodities such as farm, ranch, gold, and oil that deserve a whole separate discussion. We will focus on housing, equity, and bonds today as they are the traditional core of most investors' portfolios. The mix of investable assets vary by country. The biggest investable asset in the United States is equity at about 40% of the mix. The biggest investable asset in the UK is housing at 28% of the mix. Note the savings culture in Japan with bonds, bills, and deposits adding to 32% of the investable mix. Returns come in two ways. Investment income such as dividends, coupons, interest, and cash flows. Capital gains as realized price appreciation. We are talking about total returns today. Let's start with safe assets such as bills and bonds. Bills have returned 5% annually over the long term. Bonds have returned 6 to 7% annually over the long term. Most of the returns come from coupon payments. Bond returns are largely predictable based on starting yield. If a 10-year government bond started with a 4% yield, then in 10 years you should realize 4% annualized return for the 10-year period. In the interim, returns could be higher or lower. 10-year government bond yields got as high as 15% in 1980s and as low as 0.5% in 2020. Then we have risky assets such as housing and equities. Both housing and equities have compounded healthy returns. Housing has returned 11 to 12% annually over the long term, including both appreciation and rents. Equity has returned 9 to 10% annually over the long term, including both price gains and dividends. Although post-1950, average equity returns and housing returns are higher than the pre-1950 period that include two world wars, and equity returns in any year vary widely. However, investors usually don't get all the total returns. We need to adjust returns by transaction costs. Real estate average transaction cost is 7.7% with a 7 to 10 year holding period, so the annual transaction cost is only 11 to 77 basis points. Equity's typical transaction cost is 1.5% with a 25 to 50% portfolio turnover per year, implying an annual transaction cost of 38 to 75 basis points. So transaction costs for both real estate and equities have some small effect on total returns, but transaction costs have decreased dramatically in recent years. Let's also adjust the total returns of equity and housing by taxes. Tax laws vary by country, so we'll just use the US for example. Equity dividends are taxed as income, and capital gains are taxed at a capital gain tax rate. Housing capital gains are taxed at a capital gain rate too, but owner-occupied homes have been granted exemptions in many cases. Although housing is subject to property taxes at around 1% of the property value. You can argue that leverage can be applied to housing to boost return, but when you subtract the initial financing costs and annual debt servicing costs, the boost to housing return from leverage diminishes. Likewise, you can leverage equities. Leverage can be applied on the company's books or, less commonly, investors' books. We'll save the complex discussion of levered returns and the risk associated with leverage for another time. You should expect 4 to 5% higher returns from risky assets relative to safe assets over the long term. We call this 4 to 5% higher return risk premium. So, if you want to build wealth over the long term, own risky assets. Between the two risky assets, real estate and equities, you can get similarly strong returns over the long term at around 10% before transaction costs, taxes, and leverage. Investing involves risks. Obviously, there are many risks, but let's focus on volatility, drawdowns, and default today. Contrary to the common belief that bonds are safe, bonds have decent amount of volatility at 9 to 10% standard deviation. Equities have very high volatility that can exceed 20%. Equities have become more correlated with each other over the years, so the volatility has become more difficult to diversify away. Housing has volatility at about 10%. At similar returns, housing is much less volatile relative to equities. Real estate offers an attractive risk-return profile. The way most housing and equity indices are constructed make a difference too. Housing indices tend to be an average in a given period, where equity indices compare end-of-period prices. That makes equity indices prices more volatile. If we compare apples to apples by using average price in a given period for equities, we should reduce equity price volatility by about a fifth. This is a meaningful adjustment, but not enough to change the overall picture that equities are more volatile than housing. The high return to volatility profile of housing is attractive to investors. It's not only important to consider the short-term volatility, but also extended periods of bad returns, called drawdowns. Again, contrary to the common belief that bonds are safe, bonds and bills can have extended periods of large drawdowns. 1910s and 1940s, for example. Equities can have periods of large drawdowns. 1910s, for example, and periods with near zero returns. 1970s and 2000s, for example. Housing tends to be more stable, although it can get large and prolonged drawdowns in the local market. The worst risk of investing is losing your money. We call this default. Default destroys wealth. When you invest in bonds, you typically lend money to the government. Default risk rises with worse physical and economic health of a country. With highly rated government bonds in the developed world, default risk is essentially zero. Equities have defaults throughout history, as many businesses don't stand the test of time. The risk of default is meaningful with really small companies. And usually, equity owners are the last ones getting paid after bondholders. That said, default risk is minimal when you invest in quality companies. Real estate investing involves default risk, but because real estate is a real asset with tangible and intrinsic value, a house can't default. Even if a natural and man-made disaster destroys the property, the land is still intact. The more common default risk is when you have a mortgage on the property and you miss a payment. You lose the property to the lender or bank. Now you know the menu of investable assets. We explored in depth into bonds, stocks, and real estate. Real estate and stocks offer the highest returns over the long term, at about 10% annually. Stocks are more volatile than real estate and bonds. Real estate will experience less drawdowns. Bonds will have less default risk. I think real estate offers the best risk-return profile, and stocks offer the best upside and variety of underlying businesses. Would you agree? Please check back for more content and share with others if I provided you any value. Thanks for watching.